let's get right into it. First up, what is interest? Now, the definition of interest is basically money on top of the principal. And you might not understand what this means, so I'll just explain it to you. If you loan $10 to your friend and ask for $12 back, the $2 is interest. You want the $2 because you gave them your money for so long. However, it can also work in other ways. For instance, if you give money to a bank, they will give you extra money on top for investing in them, like a thank you. So, I'll give you a question to explain this interest a little better. The question is, what is the interest on $1,000? What is the interest on $1,000 with 10% interest over 3 years? Now, this might be a little complicated, so I'm going to break it down for you. What is the interest? The interest being the money on top of the principal. Now, the $1,000 is the principal, the original amount of money invested. The 10% per annum is the rate of interest, which just means you're getting 10% each year. Per annum means per year. And the 3 years is the terms, the number of terms, which just means you're going to be getting it over this many years. I'll lay it out for you. So, in the first year of the investment, we're going to get $1,000 times 10%, because 10% is the rate of interest, and we're going to get $1,000 interest. In the second year, we're going to do the same thing, $1,000 times 10%, and we're going to get another $100. And we do the exact same thing for the third year, getting us another $100. In total, if we add up all of those $100, we're going to get $300. And that's the answer. $300 is the interest. Here's a nice little calculation I'll put on you here to make it simpler. But this, importantly, is simple interest. Now, that we've done the simple interest, I'm going to give you a new question. What if, at the end of each year, instead of doing our usual thing of timesing 1,000 by 10% and getting our $100 interest a year, instead we get that $100 and add it on top of the principal? Won't we get more interest in the next year? This is called compound interest, and the act of adding the act of adding the previous interest onto the principal is called compounding. Now, I'm going to lay this out to you to give you a better example so you can understand. We're going to do the exact same thing. What is the interest on $1,000 with 10% interest per annum over 3 years? Now, in the first year of the investment, we do the exact same thing. $1,000 times 10% gives us $100 interest. But this is where we change things. We get our principal, $1,000, plus our yearly interest, $100, add them together, and we get $1,100. Now, in the second year of the interest, we get that entire new principal, $1,100, times that by 10%, and we get $110 interest this year. So, we do what we did last time and add that onto the previous principal of $1,100, giving us $1,210. In the third year, we do the exact same thing. $1,210 times 10% gives us $121, and then we add that onto the $1,210 to give us $1,331. Now, since we just want the interest, we're going to minus the original principal of $1,000 off the $1,331 to give us $331. Now, as you can see, that's a bit more that's a bit more interest over with our simple interest. However, there's a few easier ways you can do this calculation, such as instead of timesing it just by 10%, we times it by 110%. and that way we don't have to add the interest on at the end of each year. Or I can just give you the compound interest formula, which really makes your life much better. I'll put it up on the screen for you. I've explained both simple and compound interest, so now it's time to have some fun. I've got a new example question. Joseph invests $2,500 in Benjamin Bank for 5 years at 7% interest per annum. Now, he's got a choice to make. He can either use simple interest or he can use compound interest. Now, it's our job to figure out what the result of the 5 years will be. Also, you may have remembered I've given you some formulas earlier on in the video, the simple and compound interest formula. We're going to be using those in this question so you can understand how to use them. Bear with me, I will be using a little bit of algebra, but if you don't understand algebra or you don't like it, I have told you how to work it out in other ways, but to be honest, this algebra isn't going to be very complicated, so if you listen, you will understand. You'll probably want a calculator. Alright, let's get started. First, we'll do simple interest because, well, it's simple, pun intended. So, first we get the principal, $2,500, and then we times that by the rate, which is 7%. So, 2,500 times 7%, or if you want to, 0.07 works the same way, and we get $175. Now we times that by 5 years, giving us $875. That's our interest. Do know that you can just plug the whole thing in the calculator and you'll get the exact same answer. I'm just being a bit thorough. Actually, it's probably better you plug the whole thing into the calculator, but I'm just explaining it. Alright, so now we're going to do compound interest. First thing we do is we get our principal, $2,500. Next to that, in brackets, we put 1 plus 7%, 7% being the rate, or we can put in 1 plus 0.07, 7% is just easier. Now, outside the bracket, we put in a power, or superscript, or exponent. It's got a few names. The 5, it's just the little text on top. It multiplies it several times. If you understand this stuff, you'll know what it does anyway. And we're just going to add that 1 and 7% in our next line of calculation. So $2,500 in brackets 1.07 out bracket, and above that is it's to the power of 5. Now we're going to put that all together, 2,500, and in brackets, well, just times by now 1.4025 something else. It doesn't really matter, you can round it off. And that's going to give us $3,506.38. Remember, it's cents, so you can round it off to the second decimal place. We minus that by the original principal of $2,500, and we get $1,006.38. Now, I know the compound interest is rather complicated. You really need to get used to it. It's a very, very useful formula. It's helped me a lot of times. You've just got to get used to it, and it's probably better you put it all in the calculator at the same time. That way there's less room to make mistakes, because a calculator doesn't make mistakes as long as you're using it correctly. We have our answers for our question. If Joseph invests that money, if he does it in simple interest, he's going to get $875 at the end of the 5 years, while if he uses compound interest, he's going to get $1,006.38 at the end of the 5 years. You might be asking to yourself, why is it that compound interest earns more money? Well, it's because you're adding the investment, the amount that you've earned at the end of each year or at the end of each term, on top of the principal. This allows for the next year to be more interest, and it just keeps going up and up. The more time you're investing, the more interest you're going to get. It is very, very useful in financial maths, and if Joseph is smart about this, he'll know that he should use compound interest in the Benjamin Bank. Either that or he can find a higher interest rate. That's a good one as well.